Welcome to the latest edition of Wealthpin's One Stock, where I analyze one stock in less than 5 minutes and tell you if I think it's a buy or a sell. Never a hold, because that's just lame. Today, we're looking at NextEra Energy. They're the largest electric utility holding company by market cap in the world. And they're also the world's largest generator of renewable wind and solar energy. The first thing I always look at with a stock is its company profile. If I don't understand what the company does, I don't invest in it. NextEra, again, is a utility company with 41% of its energy coming from fossil fuels and non-renewables, and the rest coming from renewables like solar and wind. So, pretty self-explanatory there. I get it. The next step is to look at NextEra's profitability. If a dry cleaning business was losing money, would you invest in it? No, right? Well, the same goes for publicly traded companies. We want them to be profitable. How do I measure profitability? With two things: gross margin and net margin. I look for a gross profit margin of at least 50% and a net margin of at least 15%. I call it the 50-15 rule. NextEra's 5-year gross margin is 54% and the net margin is 23%. So it passes step 2. Step 3. Is a company well run? This is a hard question to answer and involves a lot of qualitative analysis, but there is one number that we can use as a pretty good indicator. It's called the return on invested capital, or ROIC. ROIC measures how efficient a company is at allocating capital to profitable investments. I usually want to see a ROIC above 20%. What's NextEra's? In 2022, they were just 4.18. This is not good. It's far below the utility sector average, and even worse, from 2019 to 2022, ROIC actually dropped 37%. Okay, but maybe there's a reason for that drop. After all, NextEra is heavily involved in the renewables sector, so maybe the fall in ROIC is just NextEra gearing up for the next phase of growth. Or maybe not. Since 2018, NextEra's net debt has increased from about $48 billion all the way to $64 billion. That's a 30% increase. So, not only is NextEra not seeing a good return on its capital, but it's going into increasing amounts of debt to achieve that poor return. So, NextEra fails this step, but maybe it can redeem itself in other ways. So, let's move to the next phase: winningness. I made up that word, but it means I only care about stocks that have a history of winning. I look for companies that have returned 10% compound growth over the last decade. As you can see, at 16%, NextEra does check that box. What's more, it's also doubled the industry average of just 8% compound growth. So, NextEra does get a badge for winningness. But wait, before you get too excited, let's look to see if that growth is actually underpinned by anything real. Step 5, revenue growth. A stock can go up for a lot of reasons, and not always because the company is becoming a better business. This is why I look at 3-year average revenue growth. I want to make sure that a company is actually growing its bottom line. NextEra's 3-year annualized revenue growth is just 2.95%. That is a big red flag. NextEra stock is up about 65% over the last 3 years, far above the actual revenue growth of the company. I see this and I start thinking that the price is overheated versus the actual financial situation of the company. But thankfully, I can check my intuition with a simple number. Step 5, the price to cash flow ratio. I'm looking to see if the current stock to cash flow ratio is below the 5-year average. If it is, it could indicate that the company is undervalued. NextEra's current price to cash flow is 18.92, which is above the 5-year average of 16.74. So, NextEra does not pass this step. It's overvalued. So, what's the verdict? NextEra is overpriced, taking on too much debt, and is not increasing its revenue nearly enough to justify its current price. For me, that's a big sell. But what do you think? Let me know in the comments, and don't forget to like and subscribe.